We're back with the first Dunham quarterly snapshot of 2024. At the end of every quarter, we give you our insights on global markets and the economy, all summed up in a few minutes. Now here is a member of Team Dunham to take it away.
Equity markets soared in the U.S. during the first quarter of 2024 as fiscal deficit spending, expected interest rate cuts, and enthusiasm for AI have been key factors driving market momentum. On the back of this, the S&P 500 has hit multiple new record highs year-to-date, now eclipsing 5,200, exemplifying the strong start of the year. The NASDAQ also hit a new record high in March of 2024. Global markets, for the most part, have also risen year-to-date, with the MSCI All-World Index EX-U.S. up 4.53%. And while not as strong as the U.S. counterpart, it's a solid beginning for 2024. Bond returns were slightly negative, with the Bloomberg U.S. Aggregate Bond Index down in the first quarter. Mentioning bonds, the U.S. yield curve remains inverted, meaning that 10-year treasuries yield less than their 2-year counterparts. This situation has lasted a record 635 days and signals some potential stress in credit markets. The Federal Reserve still foresees 3 interest rate cuts in 2024, despite the recent rise in inflation. Keep in mind that any interest rate cuts would potentially stimulate the economy. For instance, individuals purchasing homes, cars, and using credit cards would experience some relief through lower interest rates. This could have a positive ripple effect on housing prices, automotive manufacturers, and overall consumer spending. Moreover, the U.S. Congressional Budget Office has projected a reduced federal deficit of about $1.5 trillion for fiscal 2024. While this figure is slightly lower than previous estimates, it remains one of the largest deficits outside the context of the COVID-19 pandemic. Given the hefty government spending and anticipated interest rate cuts by the Federal Reserve, there is a strong indication that robust economic growth could persist throughout the remainder of the year, potentially driving up stock prices. However, the flip side of increased spending and monetary easing could be a resurgence of inflation, a matter that might spark controversy in the upcoming presidential election in November 2024. Further interesting news appeared in Q1, also on the consumer side. Consumer debt continues to rise, and so does the pace of missed payments. According to the New York Federal Reserve, approximately 8.5% of credit card balances and 7.7% of auto loans became delinquent in the fourth quarter of 2023. The transition into delinquency for credit cards and auto loans continue to exceed pre-pandemic levels, especially in the subprime arena. This implies heightened financial stress, particularly among younger and lower-income households. Meanwhile, banking issues saw renewed scrutiny after shares of New York Community Bancorp plunged 66% year-to-date amid large losses on its commercial real estate loans, sending shockwaves through the regional banking sector almost 1 year after the Silicon Valley Bank fiasco that saw major banks implode. Banks may feel continued pressure over the rest of the year as commercial real estate loan losses begin compounding. While the markets continue to rally, beware of potential volatility over the remainder of the year.
We hope you enjoyed our Q1 2024 Dunham quarterly snapshot. Please subscribe to our channel to stay up to date on the latest Dunham Insights. Until next time.